I think where the best lenders or the best loan officers, so to speak, are found are the ones that can bridge the gap between where the street needs the money and where the capital truly wants the money to be.
Hello, everybody. It's Jake Gino, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, chef, father, six, best-selling author, the G-Daddy, Gino Barber. Gino, how's it going?
Mr. Stenziano, I'm here, just doing it and doing it. Like the shirt today, bro. How you doing?
Dude, always making it happen, coming off a nice 4th of July weekend. A lot of bang-bang going around in the neighborhood. You know, a lot of bang-bang about to come at you today because we're talking the crux of this and how to make some serious cash money. We got a very special guest. Today's guest has been in the real estate industry for over 13 years, spending the bulk of his career with a multifamily developer. He has a diverse background with roles including construction supervisor, loan officer, and real estate investor. So without further ado, Matt Lineberger, welcome to the show.
Thank you, guys. Appreciate you having me on.
Hey, it is our pleasure. Let's unpack your ascent a little bit, your rise to the top here. I want to know about a little bit of that construction background and your entry into this multifamily space.
Sure. So got out of school and took a job with a national home builder here in the Atlanta, Georgia area. That's where I've spent the bulk of my career. And while I loved the home building side, got a great opportunity to join two experienced developers doing multifamily value add, also in the Atlanta area, and that was honestly a just phenomenal experience. Got to see the ins and outs. It was a small group, so literally was handling everything from day to day, activities to high level decision making. So honestly, one of the best experiences of my life, and still continue to this day to use those lessons in my own personal investing. And then of course, when I'm looking at deals now on the debt side with Lima One Capital, and been with Lima One about 8 years now, and really just love to dive into anything and everything multifamily, from value add to stabilized, and try to put these deals together. So it has been a very fun ride at, not only for myself personally, but with Lima One. I mean, we've gone from, on average doing about 2 million a month to doing well over 100 million a month. So just in an 8-year span. So it's been a whole lot of fun on the debt side.
What made you leave the building side and go to Lima One?
They retired. The two developers I worked for, they hired me because they needed someone who had a little more energy to help with that day-to-day stuff. They wound up retiring. And so wanted to stay in the industry. Didn't know exactly where. Their capital retired with them. I should also make that clear. So, found my way over to Lima One. They were actually founded in Atlanta, so I knew some of the same contacts. And they wound up. The original owner is from Greenville, South Carolina, and he wound up taking the company there with him about a year after I came on. Left me here in the Atlanta office to kind of head things up here.
So Matt, let's be honest. How'd you feel when you got the call? Matt, we're retiring. You're out of luck, my friend. Where do I do next? Let's peel that onion back a second, bro.
Yeah, it was a great job. So I was a little bummed by it, but it all worked out. So no regrets.
So Matt, what did you like about building? I mean, before we get into the finance aspect, what were the positives of building and what are the negatives of building?
Yeah. So, well, let's just put it this way. I am now in the finance world. I am not out there on the job site anymore. I don't mind going to job sites. I actually feel at home on job sites, but it is a constant strain keeping up with labor, supplies, and the daily headaches that come with that. Mm-hmm. And so I do have sympathy for the investors that we work with on a day-to-day basis. They're out there, making sure this stuff gets done right and timely, and that is a job in itself. So I have a lot of respect for those guys, but it's just kind of a different set of circumstances doing what I'm doing now versus on the construction side. Right?
Yeah. Do you have any advice for anybody that wants to get into the building side, since you did it for so long and your first job out?
I got to say, if you can if you find yourself good at that, I think that is a great stepping stone. It is something that seems very difficult to truly be good at. And if you can bring that skill set to any relationship, right? Whether you go to other investors, but if you can bring that skill set of being able to get it done on the ground, I think that brings a ton of value to any relationship that you're in. So some of the best sponsors that I work with are just the best operators, right? I mean, they just know how to get it done on the job site level, and there's a lot to be said for that. And I think that's a great place to be.
And what skill set you specifically were referring to? What do you need as far as the skill set?
I the best way that I describe it is these are guys that are constantly keeping their foot on the gas pedal, right? I mean, you cannot let off for 1 second. They're constantly up to speed with what's going on. Where should we be 2 weeks from now? Who's not showing up at my job site? Who is? How many different quotes am I getting for this item? Who did a good job? Who did not? Um, are we hitting timelines? Right? Just constantly keeping up. I personally think it's similar to the property management side. I mean, I think you have to really stay on top of it day in, day out to be successful.
And Matt, a lot of these builders, or your builders you work for specifically, they build these assets and then flip them, or what was their model?
Mainly, yeah. So most of what we did was in the value add space with existing product, right?
Oh,
So
okay.
we would go in to the Atlanta market. In the 70s, Atlanta just had a boom in population. And so a lot of your multifamily housing went up in that decade. And of course, a lot in the 80s too. But that was a tired product. It still is a tired product, right? So it set up a perfect stage for the value add model. And that's exactly what we did. So in most cases, the developers I worked for, like I said, they were getting older. They didn't want to deal with the day-to-day property management. So most of what I did with them was sell off the assets. Yeah.
And when you had the opportunity to work with Lima One, what did you know about the business?
I knew a decent amount from the operator side, from the equity side. As far as the capital markets and debt, zero, right? Just from what I knew from our banking relationships, and that was it.
Wow.
So it has the learning curve probably wasn't as steep for me as it would have been someone else completely new to the industry, but there was definitely a learning curve there.
What did you like about the industry when you got in? The same thing as the development side. There's always some great points to being a lender, and there's some awful points. Let's dive into those for a second.
So, we're always working with someone else's money, whether you're on the equity side or even on the debt side, right? I mean, there are very few true balance sheet lenders. We are actually one now, but very few lenders are true balance sheet, right? So you have a lot of guidelines, you have a lot of capital input. Is probably the nicest way to say that. So I think where the best lenders or the best loan officers, so to speak, are found are the ones that can bridge the gap between where the street needs the money and where the capital truly wants the money to be. And I think bridging that gap is absolutely crucial for success in this business because both sides want probably too much, and so meeting there in the middle is a challenge, but it's probably the win-win for both sides.
I'm an investor. What are the qualities am I looking for in a Matt to pull through a deal for me?
Performance, no BS, really.
Stick it.
Right.
Stick the landing, Matt.
I tell everyone, and we're not going, or I am personally not going to tell you something I cannot do. Right. And so first and foremost, yes, rate, terms, all that stuff. It's very important, right? I mean, that's your bottom line. But at the end of the day, if you can't trust or enjoy who you're doing business with, I think that's the first sign that it's not going to be an enjoyable process.
Matt, what do you do when you deal with investors every day who are constantly beating you down? And all they're focusing on is, and what happens in your industry, a lot of the times the salespeople are just trying to say anything to get the loan because it's very difficult. All they're focusing on, well, I could get 3.8 there instead of 3.9. I got 7 years instead of 9 years. What do you do to combat that?
I just lay it all out on the line. Just say, look, here's exactly what I can do. And if this is something that you are interested in, then I will go fight for the best rate I can possibly get you. But I'm telling you now, I've maybe got a quarter point to kind of negotiate here. So this term sheet that I'm laying out to you is something I know I can perform. I know that I can follow through with everything that I'm presenting to you. And I know I can give you a good client experience and get this deal closed. I mean, the amount of fallout.
So you're saying you got a quarter point to drop there?
Basically, yeah.
That's what.
That's all he took from that.
Yeah,
I'm being a smart ass, right? It's like that's what guys hear, though. It's like, all right.
That's right. But I tell everyone, look, this is the term sheet that I want you comfortable with, right? You have a good deal, or in some cases, you have a so-so deal. So I may not try to get as aggressive, but if you have a good deal and you're a good sponsor, I'm going to go to bat for you. And I look, we're not a shop that can provide 4% money. We never have been, and we never will be. But there are certain headaches that come with 4% money versus 6% money. So
unpack the product, though. I think we're getting a little long into it before. Like, I just explain your product and how it works before we get too far into it. Yeah.
Sure. So the vast majority of what we do is a value add bridge loan. Okay. And what that means is we are lending on the purchase price as well as the renovation, right? So we're going to break it down from a loan to cost standpoint.
Woo! Loan to cost, baby. That's what
loan
we like.
Cost, right? That's a big term there.
Explain that to people in case they don't know.
Hold on a second. You hear Jake pulling out all these little tidbits. He's hearing quarter point, LTC. He's very focused. He's D on the disc. He's done. He just wants to hear the meat. Don't give me any of that fluff, just the meat, right, Jake? So we got LTC. Sorry.
Explain the LTC for folks, though.
Yeah. So loan to cost, right? We're going to go off a blended loan to cost. Let's just take very easy numbers. Let's say you're buying for $1 million and you're putting $1 million worth of rehab in it, right? $2 million total project cost. And we have a loan program where we will come in and say, okay, we will do 80% loan to cost with you, right? So we will do 80% of 2 million or whatever your total project cost is. We can actually go up to 85% loan to cost. That's going to be a little more expensive, right? Because that is more lender leverage being offered to the sponsor. So loan to cost can go anywhere from typically 75 to 85%, right? And if you as a borrower say, you know what, Matt, we have some equity that we want to put to use here. We're going to come in at 75% versus 85%. Great. I'm going to give you a better rate for doing that. That's less exposure to me as the lender. So ultimately, the way it breaks down is we will give 100% of the renovation funds that go into escrow for the borrower to draw upon as the work is being completed and only when it's being completed. As much as we love general contractors out there, folks, we will not pay them up front on your behalf. That is a recipe for disaster.
That's from experience, personal experience, right, Matt?
You better believe it.
Nothing personal. Hey, so term on these
2 to 3 years, right? So
2 to 3 years. Yep.
Base term is 2 years with the option to extend twice for 1 year. So 2 plus 1 plus 1.
So out to 4 years, IO throughout the entire period, I'm guessing, right?
That is correct.
Interest only.
Fixed interest only, right? So we are not a floating rate shop.
Okay, so fixed, and the rate's going to be, dependent, so we don't need to talk about that. And these are recourse or non-recourse?
If it's over $1 million, I can do non-recourse, as long as we have credit-worthy sponsors.
Sure, but hear what he just said there, folks, and this is important because if you're going out and looking at Freddie Mac SBL and you're looking for non-recourse, some of these deals they're trying to push up to $1 million. Freddie doesn't really want to do $1 million loan. This is a great opportunity for something that may be 800, 900. He said, for above. That means I'm guessing you'll do an $800,000 loan.
We will. We will actually do as low as $250,000 for multifamily. And I can get those deals non-recourse. We just don't offer them as standard issue
Hey, prove it a little bit. Show Matt your worth a little bit and get a little track record with him. All right. Don't ask for everything up front.
Right.
You know, that's what I'm saying. Okay, so we got some nice IO, terms out to almost 4 years, loan to cost, potential non-recourse. Here's one thing I want you to unpack, and it's all really, really good stuff. And Gino, in a second, remind me, I want to talk about how we've used Bridge, up to this point, because we're a huge fan, and it's basically we built our business on it. Bridge right now versus Bridge 5 years ago. I think you're probably, and this is a guess, seeing something slightly different. Bridge 5 years ago was probably a true value add. Someone was going in, getting something with some true hair on it, and it just made sense. What I see people quoting Bridge now is truly a stabilized asset that they need to force a value add on to make the deal work, because it's not going to qualify for agency debt. And I may explain that a little bit, because you're probably going to say it better than I will, but I think you know where I'm going with this.
That honestly could not have said that any better myself. That is absolutely what we are seeing. Now, we are seeing a mix, right? There are those deals that are your true value add where things truly were mismanaged and you have someone just trying to get out. But with where the market is now, you're right. That is something that we are seeing a lot more of, where honestly, I didn't see those deals 4 or 5 years ago. Even in 2019, honestly, we didn't see that many deals like this, where ultimately they're 80 to 90% stabilized, right? Maybe it's not a perfect fit for Freddie quite yet, or in some cases, actually it is, but Freddie can't get the proceeds, right? They can't get loan to value where the buyers, where the borrowers want it. So everybody looks at the market rents and say, you know what, we can squeeze out an extra 100 a door, whatever it might be, right? So renovation budgets have actually decreased from what we're used to seeing, because they want to go in and yes, they do need to spruce some things up. They do need to put some value add to bump those rents. But ultimately, we're seeing deals that are 80 to 90% stabilized. And that is a rare thing for us, but it's all about having to force those rents, right? Oh man, we really are 50 to 100 a door light. We need to go in and reposition this to get this asset where we want.
But Matt, here's what's really happening though. There's been a ton of money printed. There's inflation that's taking place right now, and it's not that there's actually a value add that needs to take place. People are just trying to catch up with the market. So people are saying, okay, I'm going to go out and buy this deal. I'm going to overpay for it right now, whatever that means. Maybe it's a 3.5 cap where it used to be a 4.5 or something, but they're going to pay that 3.5 because they understand that the operator wasn't able to keep up with rents as fast as they're coming out. There's an opportunity to raise them. They may not need the backsplash that they used to need. They may not need the updated cabinets, or the new floor, whatever. It's literally, they just understand where the market is going, and they can achieve that simply through lease renewals in time. And so I think that's what people are buying on. And then if they're going to hold, and then the truth is, people are selling deals every 2 years now, every year it seems like. So by the time they get in with you, they're rolling it out, most likely anyways, to the next guy, the hot potato. So I think that it's a different market than it was 5 years ago. And I think this product really has a ton of value in this marketplace.
Matt, do you see continuing this trend?
Man, that's a really tough question. Yes, I do. And, we land on a lot of single family housing as well, not just multifamily. And I do see the new construction aspect in housing. I think there is a housing shortage. And just like you said, right, there is tons of liquidity out there and a huge demand and a low supply. I mean, the fundamentals seem to be in line right now. You can look at this from a couple different angles and say, man, this is the most unique. It's by far the most unique I have ever seen it, other than what happened in 08, right? This is by far the most unique market I have ever seen. But yeah, I do think it continues, certainly for the short run. And I don't know what the long run looks like. No one does. But yeah, for the next couple of years, I don't see this thing slowing down. I mean, the Fed's made it very clear that they don't want it to, and that they're going to do whatever they can to.
Well, you're at 142 today or something, right? On the 10-year. So, yeah.
That's right. So, kind of a perfect storm right now.
Mr. Stenziano, would you share with the listeners how we use Bridge to grow our business?
Yeah, so it's interesting because we're even looking at deals right now that, to your point, well, I guess to my original point, they're stabilized, but we know that the rents can go up, and so we're saying, bridge might be a good product right now because maybe they're a larger mom and pop operator, whatever the case may be, and we want to go in and, Gino and myself, we buy our own deals. We tend not to syndicate a whole lot, so that loan to cost or that loan to value is extremely important for us because we want to stretch our dollars when we're investing. We want to get the most out of them because we may not be going out and raising a ton of capital. So that's why that scenario I presented makes a lot of sense. Historically, though, we would go in, maybe we'd see something at 40,000 a door, 50,000 a door. Those are the glory days, right? Actually, it used to be like 20 a door, but anyways. So we would go in, and they were mismanaged mom and pop type deals. And ultimately, what we would do is we would buy them with essentially bridge debt, loan to cost most of the time, because we knew we needed a rehab, so we would get that financed in at 80%. Go in, put the work in for 1 to 2 years, and then we sometimes, maybe we'd refi it with a community bank to get a nice cash out, so we don't have to, put so much pressure on Fannie or Freddie from the first cash out refi. So sometimes it would be a buy, a refi, and then it may be a 3-2 prepayment with the community bank, and then in year 4 we would take it out to pasture, meaning we'd send it out to Fannie or Freddie once it's really seasoned well. They've seen 4 years of stability under the ownership. So it was basically, you go in, you fix it up for a short period of time with a loan to cost, maybe refi it once with community bank, get that cash out, and then send it out to pasture on a 10 or 15 year fix with Fannie or Freddie. That's essentially been our model, forever. And it's just the only thing that shifted is they're not as poorly run, but there's still room to go up in rent. So you need a higher leverage type of product. I think that's the huge value here. You get your dollar gets stretched further with a bridge type product than if you had to go to Fannie. Because think about the Fannie scenario. They may say we want 70% loan to value, not loan to cost, to Matt's point. So you need to get 70% loan to value versus 80% loan to cost. Well, if you do have significant rehab, $1, $2, $3 million of rehab, you're going out and raising that money. So your cost of capital is getting very expensive because you owe that pref back to the investors on that money that you're raising versus a loan to cost scenario where he's saying potentially 85 or 80, where that's all getting bundled in the loan and you're not owing that money to the investor. So you're raising less money. So whether you're buying, like Gino and myself, investing our dollars, or syndicating, your dollars are going further, and therefore, yourself as the syndicator, yourself as a sponsor, yourself as Gino over there in that beautiful purple shirt, you're actually making more money as long as everything connects and works out the way you want it to. There's always a caveat, right? You just got to make sure you execute on your plan.
Yeah, that's it. And really that's where we come in as lenders as well, right? Because we are not underwriting on these loan to cost aspects, right? We're not underwriting any in-place debt service ratios. So yes, it matters what the property looks like and what the numbers look like up front, but really we're underwriting the exit, right? So if we can see that rent pop that you guys are projecting, and we can see the Freddie or the bank exit, right? If we can underwrite to that, we are game on, and that's exactly what we're looking for. So as long as you guys can execute, that winds up being a great deal.
Bingo. You got to operate. Going back to what you started with, right? The operators are the ones that are winning. You like the folks that have it buttoned up, I have a feeling.
So Jake, when he's talking about Matt and what you're talking about is the buy right, the manage right, and the finance right. Or you need to buy them properly on the front end, but you need to finance them properly through Matt. And then it comes back to the manage right, to executing on your business strategy. Matt, what are you looking for in Jake and Gino when you're looking at these loans? What do we need to show you to qualify for one of these loans?
Yeah, so a wide variety of options there, but just to kind of narrow that in, we do want to see credit worthy from a credit score standpoint, typically minimum 660 to 680. Now, I will say if there are multiple sponsors, then we will make exceptions there, but we want to see similar multifamily experience, right? Or any multifamily experience is ideal. Now, if you have a ton of single family experience, okay, we can use that as long as you're not buying a 200 unit multifamily to start, right? If you buy a 20 unit, great. We will absolutely use that experience. So some experience. And then we we want to see that there is a pro forma that makes sense, right? So, I mean, we're a very simple lender and we're a very simple document set. We want to say, okay, hey, we have decent credit scores, we have some experience. These guys are bringing some liquidity, or they have investors that are for down payment, things of that nature. Now, what does the exit look like, right? I mean, we jump right into that exit scenario. What is their pro forma? Where can they raise the rents? Sending a buttoned up pro forma to a lender is a very good idea. It's a very good idea, right? I do want to stress that because we don't
want the money, do the work.
It's just one of those where a lot of these mom and pop sellers, right? I mean, the amount of rent rolls I have seen handwritten on a notepad, right?
That's in pencil.
That's fine, but don't do that on a pro forma, right? So that is within your control as a borrower. So decent credit, decent experience, the liquidity to get the deal done, whether from yourself or from investors, and then a good pro forma, a good business plan. That's it. That's all we want to see.
What other mistakes have you seen investors make on these deals? Whether it's the execution, whether the pro formas don't line up. What else have you seen?
Mainly the pro formas not lining up, right? Getting a little overzealous on the rent growth, right? So I mean, right off the bat, if I see a $500 a door rent pop with $100,000 renovation, right off the bat, I know something. I need to look into this a little bit more, right? So
you see that?
Do I?
You see that?
Oh yeah. Now look, we work with some really phenomenal sponsors, so it's not like we see it that often. But oh yeah,
that says Gino that may be a rosy projection, right?
Just a little bit, yeah. So we need to rein some of that in. But the other thing that we do see, because we are also a very large single family lender, right? So we see a lot of guys try to make the transition from doing one single family rental to literally 200 door multifamily. And that is a little bit too big of a jump for us to get comfortable with. So we would say, look, find someone to partner with, find someone that's got some background.
It's a big jump. Let's be honest. That's a big jump.
It's a huge jump. So that's just, 20 doors. Hey, we're on board with that. But 200 is just too much. So that's the biggest thing I think I see right now. A lot of people really getting a little too big of eyes on these large.
They got big eyes and they're out over their skis, right?
Yeah, that's right.
It's all about the sponsor, stupid, as Michael Gerber would say, right? That's basically what it comes down to. If you're not qualified, get qualified or find a sponsor who can help qualify you. Share the pie, right? That's really what it comes down to. And there's nothing wrong with a 200 unit, but there's nothing wrong with starting with a 20 unit and growing that relationship. And that's
everyone's got to get their itis. Put the work in. Prove yourself. Yeah, nothing wrong with that.
That's true. Matt, last long form question. Getting into it, how have you been able to scale from doing $2 million a month to $100 million a month? What does that look like? That growth in the company?
A lot of headaches, a lot of work. It truly has been a fun ride, but you have to scale employment at the same time that you're scaling your capital, right? And that scaling of capital probably would happen in probably 4 to 5 times in a 8 to 9 year span. So that there's a lot of moving pieces there. It's also adding product, right? So when we first started, we were not doing multifamily value add. Now that was my background, and so I'm making sure from day one that that's exactly what we're trying to go after. But a lot of work. If you are not willing to put in 12-hour days in this line of work right now, it's just not
in anything. So many people are looking for like this magic arrow or whatever the hell they want to say. You got to put the work in. Anytime you're growing something in an entrepreneurial environment, you got to do the damn work. Like I don't know any other way around it than just grinding it out and figuring it out as you go, and bringing on mentors to teach you and coaches and things like that. You got to do the damn work. And so many people are like looking to skirt it or skate it. Look, anybody that's really been successful as an entrepreneur, their first 3 years, they swallowed shit. Like I haven't met anybody that hasn't done that. I'm sure they're out there, but I haven't met that unicorn yet. So,
and they didn't sleep well. right?
Yeah.
I mean, I remember getting, none of us slept very well, really, but I just remember getting emails from the CEO who took all this on his shoulders to make it happen at the end of the day, rightfully so. But I mean, I'm not sure he slept for 3-4 years
It's
straight.
hard. Yeah,
So.
it's hard. That's one of our core values. Make it happen. I love it. All right, gang, let's take a quick timeout to hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created. Buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, we're back. Still got the purple shirts rocking. We got a lot of folks in our community that are maybe making the leap from small multis to larger, or they're like you said, they're doing single family quads, duplexes, and they're looking to level up. Give us your best tip for someone that's going through that when working with a lender. I know you said earlier, don't send us over, chicken scratch rent rolls and things like that. But any advice for as these folks are scaling and growing in their career? Is it having their docs in order? Make sure you have a schedule of real estate owned. Like what's the few tips that you're saying? Hey, when you're going to be working with me, this is how we want to see you leveling up.
Yeah, path the put pencil to paper and put a path to the trajectory, right? And know that we're not alone as a bridge lender saying we don't want you to go from one home to 200 units. I mean, we're not alone in that, right? So put that together and say, look, I'm going to go target 20 to 50 units at first, and here's how I'm going to do it, and then I'm going to continue to grow as I get more bites at the apple and as I gain experience. But yes, a buttoned up presentation. It's amazing how simple that sounds and elementary that seems, but keep up with it, right? I mean, a buttoned up presentation.
A credibility book? We call it a credibility book. Do you see those where people are like, this is basically my business plan. Here's where I'm at. Here's where I'm going. Does that help? You like seeing that?
100%, because it takes, like I said, my job is to bridge the gap between the debt and where the sponsors want us to be, right? And so I know that I have to check off a few debt boxes, right? Like, hey, does he have any multi experience? Do they have decent credit, right? So, those boxes have to get checked in my mind before I can move on even to the property, right? So any sort of background like that, and just a little write up. We work with this one guy, and he has the best presentation I've ever seen, right? I mean, he puts everything into one file, and it just scrolls down in order that is perfect. Here's my background. Here's what I've done. Here's what I own. And then here's my plan on the property. And then it goes into rent.
Make it easy on Matt, right? Yeah.
I mean, well, look, if you make it easy on me, I promise you I'll make it back to you.
I know.
Right?
Yeah.
So, I mean, it really is a nice little circle there. And you just have to remember that we see 10 deals a day, right? Or I personally will underwrite initially 10 deals a day. So yeah, I mean, it laying stuff out in a good orderly format is very, very helpful.
You want the money, put yourself in the best position possible to get the money. And also, so people understand, I know this may seem a little silly to even ask this, but why not making that huge leap from 0 straight to 200? Why are you guys, I don't want to say against, but hesitant to jump in with somebody that doesn't have someone on board with experience? What have you seen, or what's the bank's policy? Why are you not loving the idea of someone who with little experience jumping right into the deep end?
Yeah, so
people like transparency these days. That's why I'm just trying to unpack the why for folks so they really understand. Yeah.
The funny part is that we probably deal with guys that ask us that I personally think could get it done. Yeah. Right. But the truth is, when you've done as many loans as we have, and you have access to the loan data tape that we have access to across the markets, lack of experience on those units is the number one reason that they do not work out, or there is a higher
He has
default,
the data, folks. He's
right?
telling
I
you the
mean,
data speaks.
you know, and hey, there's a lot of times where you get the Matt Lineberger bump, and I say, hey guys, we need to take a risk with this guy. But at the end of the day, the data is against you. It's just that simple, right? So if you're sitting up there and and you're trying to deploy $1 billion to Lima One Capital, you don't want to deploy $1 billion to people that don't have a proven track record at all, right? So I mean, maybe you take some jumps here and there, but you know, you want a little method to the madness there, and honestly, I don't blame it. We see the same thing on the single family side, right? I mean, going from a rehab single family home to new construction is a jump that is a lot bigger than people understand, and we see it in the data, right? So yes, it's our money, and we have safeguards in place, and that's one of them.
Yeah, that makes total sense. I think sometimes just hearing it and people understanding that it's actually, this is the data speaking. We're not, we're not discriminating or being mean here. It's just, yeah, it makes a lot of sense. Any lending mistakes that you've made in your career, and any stories that you can tell? We'll omit the people here, but anything that you can share that's a good story for folks.
Yeah, I mean, I won't share any personal names, obviously.
Gino
Yeah,
Barbaro was doing this.
right, yeah. You know, the sad truth of the matter is there are people out there that are intentionally trying to commit fraud, and that are intentionally trying to pull one over your eyes. And so, you know, people get very frustrated by some of the process that maybe we have to put them through, and say, you know, look, yeah, we do have to do a background check, right? Because again, it's the data. We've been there before. We don't, you know, when 5% or more of all your applications have some sort of fraud attached to them, you have to protect yourself somehow, right? So it's not personal, but yeah, we've had title companies and closing attorneys run off with hundreds of thousands of dollars of our money, right? And I mean, we've had it the same.
Tell me about this. Now I'm scared. Tell me what happens there. You get me freaking out now.
Well, we have systems in place to stop that, right? But we're a shop where we say, hey, you bring the title company, you bring your closing attorney if you're in one of those states, right? I mean, we will work with whoever you want us to work with. But we used to do a lot of transactional funding, and we no longer do that for that reason, right? I mean, we just took too many hits. But yeah, there are just a lot of unscrupulous characters out there. And
so was it the borrower was actually working directly with the title company to do something shady? Gotcha.
Yep.
You never know, Gino. You always got to be, like Hakeem Olajuwon or Dennis Rodman. You always got to be boxing out, man.
Nice place for those people, my friend.
Yeah.
Just waiting for them. It's
That's
called
right.
karma. You don't want to do business that way, because sooner or later it will catch up with you. And, Matt could probably attest to this. You don't go from $2 million a month in loans to $100 million a month in loans with a crappy, with a crappy portfolio, or you really need to build up who you are. And karma is bad. I mean, you don't do that. You don't grow that way without not having a great reputation. And that's what they've built. And you, for a few bucks, do not do that to your reputation. It's not worth it. I know the shiny object. I know in the short term, you may have to pay some bills. You may be up against it. But listen, you've got an entire career ahead of you. Do the right thing. And it can be hard. And go out there and get coached and get mentored. Yes, and you'll make it even harder. But in the short term, it's not worth it, because we always preach the 100-year real estate investor. We always preach that long-term mindset, and it's basically your value-based decision making. You have the ability to make these decisions, and then when something goes wrong, don't go out and be blaming somebody else. It was your choice to create fraud and to go rip somebody off. So before you do something like that, stop and think about it. If you want to be like Matt, like I said, and go from 2 million to 100 million, you don't want to act that way. Assume
100% responsibility. Before we wrap this up, any book recommendations? Anything you've read in the last year or two that was meaningful?
Oh my goodness. Yes, there was one in 2019, at the very end of 2019. It was actually not long before the pandemic hit. But you put me on the spot here. I promise you I will get back to you with it. The CEO recommended it to me.
The Honeybee? Wheelbarrow
For the life of
Profits.
me, I cannot remember this. You're going to drive me crazy now all day. I'm going to have to drive home and get that book. I promise you I'll get back to you with it if I don't think of it here in the next couple of minutes. But
he was too busy working, folks. Give the guy a break.
I was about to say, man, my book is what is the literature that all the borrowers send me to read. That's my daily reading.
Awesome. Gino, you want to wrap this baby up?
Yes. Young Matt goes into development. He likes it. He enjoys it, Jake. He's having a good time.
Selling some big assets.
Then one day he gets the fateful call from the owners saying, Matt, we're getting a little old. We think we're going to retire. And Matt's like, oh, crap. I was liking this job. I don't know. What am I going to do now? Picks up the phone. He goes into lending. It must have been a really difficult transition because when you're used to one job and you like it and then you jump into another job. And from where he started, didn't even seem like they did any multifamily lending. He brought that skill on. He added value to the company. And there were a lot of sleepless nights, as he said. It sounds like the CEO for 3 years did not sleep really well. And there's a reason why. You have capital. You're placing capital. You're a steward of somebody's money, and you have to be really careful with that. And as the market's gone up, businesses increased. You're taking on more risk. There's more opportunity. There's more deals. And what's amazing about Matt's story and the whole debt markets, how capitalism's alive to me. I mean, when there's a void in the market, it seems as if a new product is created. And it seems like this bridge product that we've been talking about is alleviating some of the stresses of possibly going to Fannie and Freddie. And I think Jake laid it out beautifully, how it's helping others. And go back, everybody, and listen to the way Jake laid out how we were using bridge debt financing in our journey, in our sense, over 1,500 units.
Yeah.
There is an evolution, and it's really a constant learning. You have to be a constant lifelong learner in this process. And it seems as if that's what Matt's done. I'm going to say it once again. Going from 2 million a month to over 100 million a month to underwriting 10 deals a day. It's working 12 hours a day. That's what it takes to become a successful lender. That's what it takes to become a successful person, business owner, whatever it is, really growing, constantly learning, and adding value wherever you go, Jake.
I love it. Matt, thank you so much for your time today. Look forward to working with you more in the future, and have a great day, gentlemen.
Thank you.
Thanks,
guys.
everybody.
See you guys.